Hello, I'm Juliet Sali. In this week's edition of IG Macro Intelligence, we take a look at AI integration and ASX listed stocks set to benefit from the biggest disruption since the Industrial Revolution. Artificial intelligence is reshaping industries across the global economy at a rapid pace. From cloud computing and healthcare to data infrastructure and enterprise software, companies are ramping up investment in AI-driven tools and digital platforms to boost productivity and unlock new capabilities. A number of ASX-listed growth companies are well positioned to benefit from the disruption.
The AI evolutions is continue despite all the conflict happening in the world. So we think the leadership is moving from software, as we all know, and platform into the chips, into the hardware, into the infrastructure, into the industrial. Those are the sectors that are likely to generate earning growth. So the AI is come from a phase where over the past 3 years, there's a lot of money being spent on training, and now going into realizing money over the next 3 years.
One ASX-listed stock to watch is Xero. It's teamed up with Anthropic to embed the Claude AI model directly into its accounting platform. The multi-year partnership will power Jax, Just Ask Xero, an AI assistant designed to deliver real-time financial insights, automate cash flow tracking, streamline invoice management, and support payroll tasks.
So our deal with Anthropic is using Anthropic's advanced reasoning to be able to do more agentic workflows and actions within Xero. And then, of course, our customers that are small businesses and their advisors work in different places. So what we are also doing with Anthropic is making it possible for small businesses and their advisors to be able to work from wherever they want. So while they're in Anthropic, they can ask Xero a question right then and there.
Well, the global sell-off in tech shares has seen Xero lose about a third of its value so far in 2026, while shares are down around 55% over the past 12 months. Analysts, though, see its deal with Anthropic as positive.
It's beautiful. This is a stock that you need to come back and look at. So many people are locked into the Xero ecosystem that they can't get out of easily. Now, criticism I have of Xero is that they've slacked back on the R&D front a little bit. There are certain functionality, if you talk to your accountant, that they would love to see, but no one at Xero seems to be getting around to doing those fixes. You bring in Anthropic to fix that. You put Xero back on the front foot. So I think this is the best news of the year for Xero.
But shares do appear to be in a long-term bearish trend, as confirmed by ASX TradeWatch data, with the 200-day moving average falling, suggesting demand for the stock is low. However, analysis by Refinitiv suggests brokers are positive on the stock. The average broker recommendation is a buy with an average target price of $160.83, suggesting Xero can rally nearly 130% from current levels. And in the wake of the deal with Anthropic, Citi has retained its $144.80 target price, citing the partnership as an example of ongoing collaboration between AI developers and software providers. As for its part, the accounting software company plans to aggressively accelerate its 4.6 million subscriber base.
So really what our focus has been not to get distracted by what's happening in the markets. It's really to double down on our strategy, which is working for us because we are getting the feedback from all our customers, as well as getting feedback from not just through verbal feedback from them.
Well, NextDC is another growth company set to benefit from the AI boom. Demand for its infrastructure is expected to remain strong, and Morgan's recently rated NextDC a buy with a $20.50 target price. Shares, though, pretty flat over the past 12 months and are down 10% year to date. Analysts, though, are positive on the stock, with its average target price of $21.19 as surveyed by Refinitiv, suggesting it can rally 85%. However, sentiment among investors has been weak, resulting in a bearish sloping 200-day moving average when looking at ASX TradeWatch technical data.
In our mind, the best data center operator on the ASX is an NXT, so NextDC, and that's just based on the fact that they just keep winning contracts. They just keep winning megawatts, basically, and the tailwinds supporting the whole investment thesis don't have any signs of slowing down. So you're obviously seeing businesses continuing to sort of digitize their processes. leaps in cloud computing, and as well, obviously AI as well. So it's there's just got a huge number of tailwinds.
Well, the ongoing conflict in the Middle East could pose a risk to the AI investment thesis, at least according to Capital Economics. Senior economics advisor Vicky Redwood believing the Iran war does pose a threat to the pace of the AI-driven revolution, as higher energy prices could lift the cost of running infrastructure and dent projected returns. However, Capital Economics remains optimistic about AI's long-term outlook, but with one caveat, that it could shift where capital is deployed, with the Middle East likely to see reduced investment amid rising security concerns. And that is your IG Macro Intelligence for this time. We'll see you next time.